The post-pandemic economic volatility has finally subsided. As the global market stabilizes in 2026, we are entering a phase defined by strategic consolidation and more disciplined capital deployment. Broader market tailwinds are no longer enough to guarantee growth. Performance is now increasingly tied to mandatory technological integration and verified ESG compliance. This diagram weighs these integration requirements against significant macroeconomic pressures, high construction costs, and persistent geopolitical uncertainty. As these opposing forces compress margins, investors are finding that rigorous asset selectivity is essential to protecting long-term yield. The business brokerage and M&A sectors are currently sustaining momentum from a 2025 rebound that saw deal values rise by over 40%. While high-value megadeals led that initial recovery, the mid-market segment has become the primary driver of consistent transaction volume in 2026. This chart shows the current valuation benchmarks for stable mid-market acquisitions, with EBITDA multiples averaging between 6.8 and 9.8 times. Reaching the peak of this range depends on operational maturity. Documented, digitalized processes are now a primary differentiator for companies seeking these higher valuations. This data suggests that the strongest seller leverage in 2026 belongs to firms that can pair predictable cash flow with clear evidence of AI readiness. In the commercial real estate sector, stable global conditions are driving a projected 16% increase in investment liquidity across key markets. The industrial and logistics sectors remain top performers, fueled by sustained e-commerce growth and the expansion of nearshoring operations near the US-Mexico border. Additionally, the rapid adoption of artificial intelligence has created a critical need for physical infrastructure, specifically in the data center market. Multifamily and residential commercial assets continue to show high resilience, supported by the ongoing demand for workforce and affordable housing. Unlike these high-demand sectors, traditional office spaces are being forced to adapt, with many converting into flexible, mixed-use environments to maintain relevance. Geographically, European and Latin American capital continues to flow into U.S. Sunbelt states like Texas and Florida. This map identifies the primary Latin American growth engines, specifically Brazil and Mexico, which are projecting a compound annual growth rate exceeding 6%. High-density urban hubs within these nations are capturing the majority of this expansion, specifically in areas supporting mixed-use and co-living concepts. Capturing this geographic yield requires balancing these growth rates against local construction costs to isolate premium assets from secondary market risks. The window to acquire premium assets at post-2022 corrected prices is narrowing as competition for quality inventory increases. Investors are looking to diversify by combining real estate with complementary business acquisitions, such as an industrial property paired with a logistics firm. Strategic success now requires three pillars: diversifying across sectors, mandating tech and ESG upgrades, and accelerating comprehensive due diligence. In 2026, the market rewards those who replace speculative timing with early preparation.